Welcome back to another video. Soil here, and today we're going to discuss 5 important points about price action trading that you must consider and pay attention to them when you trade based on price action analysis. Stay tuned and let's get started. No hard rules and show flexibility. Don't look for perfect patterns explained in books. They rarely happen that perfect in practice. The important point about the patterns that you must consider is that they show changes in buying and selling pressure. Actually, they show if the market participants are more interested to buy or sell, and you must perceive this from the price action forming on the chart, not just looking for patterns. For example, here on the left part of this chart, we have an inverted flag pattern but not in perfect shape. All that matters is that after a sharp decline, we have a tight consolidation period, which shows a period of indecision among buyers and sellers, and after that, a breakout in the direction of the prior move, which indicates that the bears took the control again and the market participants are going to sell more and the price is going to decline possibly. Or on the right side of the chart, double top pattern, not in perfect shape, but all that matters is that the bulls are weakening, they couldn't make higher high, and the price breaks the support level made by previous low, which confirms the bulls lost control and a downtrend is possibly forming. Please pay attention that the market is the most dynamic entity you can imagine, and the price and patterns forming on the chart constantly change based on the forces of supply and demand, so expecting to have patterns in perfect shape like what you see in textbooks is naive, and professional traders never think like this. All that matters is to realize and understand how the market participants are acting. Their behavior and actions are reflected on the chart in the form of price action. So the goal is to analyze the price action to identify changes in the behavior of buyers and sellers. Context is extremely important. When you're analyzing the price action based on where a price action is happening on the chart, it may have different meaning and interpretation. For example, if this candle is formed somewhere in the bottom, it's considered bullish, but if it's formed on the top, it's considered bearish, and if it's formed somewhere in the middle of a move, not very significant. Also, when a news releases or a fundamental factor affects the market, they are reflected on the price chart and they show themselves in the form of price action, and they may cause some extreme moves in the price action before the market settles down, and you must consider these situations. So you must pay attention to the context and adapt to the current situation of the market and show required flexibility. Don't miss confluence of levels. Confluence of levels provides you strong areas that can hold significantly. Always try to look for confluence of levels because it actually shows that market participants have special attention to those areas and show reaction to those areas one way or another. For example, on this chart, you can see that we have a strong support level holding for a while. It's broken here and it changes role and becomes a resistance level. And on the other hand, a downtrend is forming, and this is our downtrend line, which is acting as a resistance level. And here at this area, we have confluence of the two resistance levels that makes it a very strong resistance zone. So always try to look for these kinds of confluence levels that show very strong levels or areas, and they can provide you high probability trade with minimum amount of risk. You can't fight the market, so pay attention to the overall trend. Definitely you've heard the sentence, trend is your friend, and that is absolutely true. When the trend is up and you take a short position, it has much higher risk of losing your money in compared to taking a long position in the direction of the overall trend. For example, on your chart, when the trend is up, taking a long position in the direction of the trend is a high probability trade because you're entering in the direction of the current trend. But you must also pay attention to the overall trend of the market in higher time frames based on your trading style. For example, if we switch to higher time frame, you can see that the uptrend that we had is just a correction in a downtrend in longer time frame. So you must always pay attention to the overall trend of the market and major support and resistance levels to be sure that you are entering in the direction that is not against to the overall direction of the market, or you can prepare required measures to limit your losses. I have a complete guide to multiple time frame analysis. I also put the link in the description of this video, and I recommend you to watch it later because analyzing multiple time frames is extremely important in price action trading. You can't control the market, but you can control your losses. Risk management is the most important subject in trading that traders must learn and develop. Without a proper risk management strategy, you'll be definitely out of the game because you're not going to win every trade, and without a risk management strategy, your losing trades will be out of control, and a few losing trades are enough to wipe out all your profits or even your account altogether. One component of risk management strategies for controlling losses is setting stop loss, and it's really important to set it correctly based on price action. Some traders use fixed percentages for setting stop loss, which is not correct, and your stop loss and even your take profit orders must be based on price action. In a separate video, I will completely explain how to set correct levels for stop loss based on price action, so make sure you will not miss it. Please pay attention. Controlling your losses, in fact having a risk management strategy as a whole for managing your losses and profits, is one of the most important aspects of trading that you must learn and develop it correctly. There are different risk management strategies that you can test and practice and develop them to match your trading style and trading system. We have a risk management strategy that is called 1% rule, and it's very popular and common among active traders. I have a video on this. The link is also in the description of this video, and I recommend you to watch it and learn this excellent risk management strategy. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you found any value in this video, please like it. Please subscribe to my channel if you haven't already, and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.